My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make a little money. My job's not just to entertain, but to teach you. So call me at 1-800-743-CNBC. Tweet me, Jim Cramer. Maybe we are looking at retail all wrong. Maybe this whole discussion about whether the consumer's sick, the consumer's well, the consumer's frugal, the consumer's hard-pressed is just a big pile of manure. The consumer doesn't switch on a dime, people. The consumer doesn't get sick and then get well within the span of a quarter. And as we ponder what the Fed's going to talk about Friday at Jackson Hole, with the averages hanging in there, Dow inching up 56 points, S&P advancing 0.42%, Nasdaq gaining 0.57%, we have to start rethinking the great debate about the state of the consumer, as it is at the heart of what the market will need to get the rate cuts we have to go much higher. First, let's set the stage. As everyone knows by now, the Fed needs to start cutting interest rates before the economy deteriorates to the point where they need to scramble the jets to save the day. But they can't move if the economy is doing fine and the aggregate retail sales data is inconclusive. So we're always trying to extrapolate from individual retailers, and taken together, they seem to be saying that the consumer is fickle and perhaps in some cases tapped out. Tonight, I'm contending that she's not fickle. Not at all. People are shopping, and they're shopping where the great retail CEOs are doing fabulous things, like Ron Vakras, Doug McMillon, Ernie Herrmann, Brian Cornell. That's where they're going. Don't know him? Okay, Ron Vakras is the new CEO of Cramer Endless Fave Costco. Doug McMillon has pulled off an amazing, successful multi-year turnaround at Walmart. Ernie Herrmann is extremely low-key CEO of TJX, the $135 billion off-price colossus with 5,001 stores that captivate the American consumer. And Brian Cornell runs the return-to-growth chain that is Target, which saw its stock surge 11% today. The consumer isn't frugal or tight-fisted or sad or happy. People are simply shopping where they want to go and not shopping the other places, which is where these great merchants drive them because they're what matters. The chains that say the consumer's really strapped may just be getting not enough traffic because they're not good enough to make the cut. Why didn't we think of this? Let's take them one by one so you understand why I'm so sure of this. All told, they represent pretty much the entire successful consumer cohort of a country, we remember, that runs on services, not goods. I want to start with Target's Brian Cornell because the company just reported some just excellent numbers. The Street was looking for 1% same-store sales growth, but Cornell delivered twice that. You analyze same-store sales by looking at how much of the gain is traffic, people coming into stores to shop, and how much is changes in price. You don't want that. Target said their gain was entirely from traffic, which is excellent because price increases will distort our thinking, and they're also inflationary. Traffic tells you a great deal about the consumer. Pricing tells you almost nothing. Target's house of brands, Cat and Jack kid clothes, Cloud Island for baby essentials, Good and Gather for food and beverage, Up and Up for household essentials, Threshold, room essentials, Bright Room for the home category. Each of these do about $1 billion in sales, and Cat and Jack alone is $2 billion. Is the consumer rational to spend so much on Target's brands? You bet she is. She's discerning. She knows a bargain when she sees one. She's not a barometer of the economy. She's a customer of Target. And the numbers show that she's shopping more than she has in ages. Some of it's because Target has perfected order online and pick up in the store. Some of it's the loyalty program. But these brands are unique to Target, and that's why it happens. It's Cornell. Unique. And because they are made for Target, they can cut out the middleman and come up with excellent designs and fabrics and save you money. Cornell knows what he's doing. Most merchants may not. Plus, he's rolled back prices on 5,000 items, which was definitely a driver of traffic because the consumer knows that's what's happening. All right, how about this fellow, Ernie Herrmann at TJX? Now, we don't know him much. Honestly, he doesn't do road shows or television interviews. He's incredibly low-key. What he's developed, though, is nothing short of monumental enterprise where bargains abound. Sales, profitability, earnings per share all exceeded plan this morning. Once again, TJX's same-store sales growth came from traffic and not price, which is what you'd expect from the biggest off-price retailer in the country. I may not know Herman, but I know he's great at his job. Look at that stock jumping 6% to an all-time high today. I am so glad we own it for the Charitable Trust. Thank you, Mr. Herman. Walmart's Doug McMillon doesn't like to talk much about the integrals of the quarter. But one thing we know, by rolling back 7,200 prices in the store, people are going to sit up and take notice of this outfit, right? They're going to head to Walmart and they find incredibly low prices, rolled back 21 price, 2020, sometimes 2019. The chain's apparel is so long a drag to walk through. I got to tell you, it's just dazzling. It's dazzling. Plus, before you dismiss that out of hand, I want you, please, just take a look. Don't be a snob. You'll be shocked to see Walmart's great knockoffs of big-ticket apparel. The prices of their house brand foods are through the floor. It's the benefit of scale. But to say the consumer's strapped because she stops at Walmart, that's what I keep hearing. That's insulting. It's insulting to everyone. Walmart's a great American institution that too many on Wall Street thumb their noses at. But Main Street loves it. My daughters and I love going there. Costco, oh, that's like no other. This is the second biggest pure play retailer in the country, and it views its job as basically a gigantic buying group of affinity holders who will order pretty much everything. The club gets you amazing prices, including some that are below the price the store most likely pays for itself, including those bottles of Caymus I told you about the other day, and the gold bullion that people are so crazy for. Costco's a one-of-a-kind retailer where you can't find everything, but what you can find is likely going to be cheaper than you can get it anywhere else. This store has done the most to roll back prices for this nation, and it does so via premium house brand, Kirkland Signature. Costco is happy to come after any nationally branded product if it wants to that won't lower prices. And under the Kirkland label, well, I got to tell you, they get prices down because the Kirkland label is better than most of the branded stuff. Costco, Target, and Walmart are at the heart of the move to lower prices in this country. The government cannot do better than these companies are doing. If you look at retailers like this, you can reach some conclusions. They just aren't the ones that fit any narrative. When I asked Target's Cornell what was behind the better-than-expected quarter, he unhesitatingly suggested it really came down to our country's incredibly robust job market. People with jobs are people who spend. The more people with jobs, the more likely it is that Target can beat its targets. The others are in the same boat, too. I think Cornell's right on this jobs point. As he says, and I'm going to quote, consumers have shown remarkable resilience in the face of multiple challenges over the last several years, and they remain resilient today, end quote. They're resilient because they have jobs. You don't hear this enough. But historically, we still have a very, very strong labor market, even if the unemployment rate kind of ticks higher every bit. Therefore, my conclusion is simple. Can we please stop drawing a new conclusion every day about the consumer with each passing earnings report? No two retailers are alike. The ones that roll back prices, Target, Costco, and Walmart, have had terrific sales. The ones that haven't, not so good. TJX, of course, innately does because they stand for low price because they're buying closeout merchandise. When you give the consumer what she wants, which is roll back prices, she's healthy, and she stays healthy as long as she has a job. If you know the employment number, you'll know what the retail sales are going to look like. It's just that individual retailers are all over the place in terms of their performance. Here's the bottom line. We'd like everything that we report at 8:30 and 10 o'clock, we'd like it all to be consequential, right? Regrettably, that's not the case, so let's stop it. But it's great to know that you can buy stocks like Costco, Walmart, and now TJX and Target because they have the consumers back, and they offer you the best values. Maybe for our purposes, that is all that matters. Craig in Missouri. Craig.
Booyah, Jim. Thanks a lot for taking my call. Long-time fan, was listening to you in the early 2000s on your radio show, and you explained the difference between a limit and a market order to me. I've been buying on limit ever since then.
You've never been picked off. You've never been picked off. That's what I want. People who buy on market get picked off all the time. Thank you.
Thank you so much. It is awesome. I made some money on the Japan carry trade, actually.
Good for you.
Really nice. So thank you so much.
Thank you.
AMD got a price of $138 a share. Am I too low right now, or do I need to adjust?
I think that you can. Now, it's been up a very straight line this week, but I think you can buy more AMD because Lisa Su made that great acquisition, and because her stuff, I've got to tell you, for accelerated computing is terrific. And yes, for AI and generative AI, it is terrific. Buy more AMD as we've been doing for the club. Listen, guys, it's driving me crazy. Not everything you hear is consequential. There's a lot of data points that don't mean anything. Sometimes companies just have their consumers' backs, and that's where they go, and the economy's fine. And that's all that matters. On Mad Money tonight, does the healthcare sector stand out in the slowdown? I'm telling you where I stand when I check up on a name fresh off a new 52-week high. And speaking of healthcare, tonight I'm eyeing an under-the-radar eye care company that you called in on and telling you if my research reveals a buying opportunity. Plus, I'm sitting down with the CEO of Snowflake, fresh off the company's report. I know many people care about that one, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Last night, I highlighted some work from expert market historian Larry Williams, where he explained that the market's likely headed for a rough couple of months. That certainly jives with my theory that after the recent rally, Wall Street's become a lot less forgiving of companies that drop the ball. Most importantly, the economy's slowing down, and we're in kind of a no man's land until the Fed starts cutting interest rates in order to compensate. In moments like this, you need to fall back on powerful long-term themes that work regardless of how things are going in the broader economy. I'm talking about themes like healthcare utilization. Remember, people put off so many non-urgent procedures during the pandemic that they're still playing catch-up with the healthcare system. At the same time, my generation is rapidly aging. I'm still pretty spry, but you hear plenty of stories of baby boomers hurting themselves playing pickleball. Just today, I heard my first ACL pickle injury tale. Gruesome! Best of all, healthcare works even in a lousy environment. All right, now there are some politically sensitive parts of the sector, like the healthcare insurers and the drug companies, but it's the hospitals that are the biggest winners from the spike in healthcare utilization. And politically speaking, the hospitals are much less hated than, say, Big Pharma, which brings me to the best. Brings me to HCA Healthcare, the Nashville-based company with 188 hospitals across 20 states, plus over 300 urgent care centers, 123 freestanding surgery centers, 23 freestanding endoscopy centers, and tons of outpatient services. HCA has become a juggernaut, one of the best-performing healthcare stocks in the S&P 500 this year. Now, a lot of that comes down to the post-COVID catch-up dynamic. During the pandemic, the hospitals struggled with higher costs, especially for personnel, because that obviously makes the job much harder. Plus, people weren't coming in for all sorts of profitable surgeries because they didn't want to catch COVID. Stands to reason. But last year, the pandemic was finally in the rearview mirror, and people started coming in for more health care. HCA put up 7.9% revenue growth in 2023, while its earnings jumped 12.6%. Although it took a while for investors to catch on. By late last year, the stock finally found its footing, and since then, it has been nothing short of a rocket ship. Buy! HCA is now up 74% from its lows last October, including a 39% gain year to date. That's sweet. It is the fifth best performing healthcare stock in the S&P. The hospital chain is the gold standard of its kind. The basic bull case for HCA, well, let me lay it out for you. This company is the best run hospital chain with exposure to the strongest areas of the country, and it throws off a ton of free cash flow. We know this is a great moment for the hospital, so why not just own the best hospital chain? And yes, it is the best. HCA's footprint stretches across the Sun Belt and has the top market share position in some of the fastest growing parts of the country. Miami, Florida, San Antonio, and Austin, Texas, Nashville, Tennessee, Denver, Colorado. They're number 2 in Dallas and Houston, and they've got great exposure to more mid-sized markets across the region. All these aging baby boomers are retiring to the Sun Belt, so inevitably, that means even more business for HCA. Second, HCA's scale and earnings power allow the company to reinvest heavily in its healthcare network. Now, this is a key part of the story. That's how they've paid for their big network of non-hospital locations, urgent care centers, imaging centers, outpatient surgery centers. The broader footprint helps keep customers within HCA's network, which in turn allows them to keep closer tabs on their patients, driving better outcomes. And better outcomes translates into rising market share and, of course, more money. In the markets where HCA operates, their market share has grown from 24% in 2012 to 27% a couple of years ago, and their plan is to 29% by 2030. That may sound like a slow crawl to you, but for the hospital business, they're taking share at a pretty rapid pace. Plus, as time goes on, people are spending more and more on healthcare simply because the technology keeps getting better. Things that were uncurable or untreatable a decade ago are now manageable in many cases. And we know HCA in particular is doing well because when they reported a month ago, they shot the lights out. Much better than expected sales, up 10% year over year, 57-cent earnings beat off a $4.93 basis. They had 28% earnings growth. For heaven's sake, I don't have a lot of 28% growers. Even better, HCA raised its full-year forecast pretty substantially. They boosted their full-year revenue outlook by $1.75 billion at the midpoint and hiked their earnings guidance by $1.75. $1.75 per share better? Now they're looking to earn $21.60 to $22.80 per share this year. That's incredible. Drilling down, HCA's same facility equivalent admissions rose. I know that sounds wordy. It rose 5.2%, but their same facility revenue per equivalent admission increased by 4.4%. That translated into same facility revenue growth of 10%. Now, that's like the same store sales that we often talk about for retail or restaurant. And in short, the hospital is simply doing a lot more business year over year in the actual brick and mortar that they're working in. Management noted that operating costs were well managed, rolling in 100 basis points of margin improvement year over year. Is there anything wrong with this story? In particular, their labor costs came down dramatically. Another sign that the Fed's winning its fight against inflation, at least in the healthcare segment. So even though HCA stock came in hot going into the quarter, it's been able to keep rallying, now at more than 15% since the earnings report. Even after this incredible run over the past 10-odd months, HCA still trades at just 17 times the midpoint of this year's earnings forecast. That's a little more expensive than the stock's historic multiple. But then again, the S&P 500 is currently selling for well above 20 times earnings. I think HCA's got more room to run because it's an incredibly well-run business. Now, given all this, that the stock's at an all-time high, I don't want to ignore the potential risk here. There are a few things that potentially could derail the story. Maybe people finish catching up on the deferred healthcare procedures. I've been waiting for that to happen. It hasn't happened. Maybe the Democrats have a big win in November, sweeping the White House, the Senate, and the House, and decide to target the hospital chains in order to tamp down on healthcare costs. Normally, they go after pharma and the insurers, but that doesn't mean the hospitals are off limits. But the real long-term threats to the hospital are within the healthcare industry. There has been a concerted effort to focus on preventative care. We talk about this a great deal on the show. The managed care outfits are thrilled to pay for anything preventative. Think about the GLP-1s from Eli Lilly, because it keeps you out of the hospital down the line. But HCA is the least vulnerable because they've been diversifying in the non-hospital facilities for years. At the end of the day, it's a good thing if people get healthier and need fewer hospital visits. Although, obviously, that's not so good for HCA shareholders. Still, it's a very long-term risk, one that you'll easily be able to see coming if it starts to become a problem. So here's the bottom line right now. The caregivers within the healthcare space have become some of the best performers in the market, and I'd argue the single best option here is HCA Healthcare. After I did the work on this, I said, maybe this belongs in the charitable trust. Stocks had a huge run, though. Maybe you put it in your shopping list and wait for a pullback as what I'm thinking we should do for the trust. Then again, given the way HCA has been trading, you might want to put on a small position right here, right now, because I'm not sure it's going to come in anytime soon. Oh, and by the way, you have every right to ask me where I've been on this one, because I know the answer. I've been asleep at the wheel. Mad Money's back after the break.
Coming up, beating the street can be a harrowing experience. Cramer has an under-the-radar play that could be just the ticket. Next.
Whenever you call in and ask about a company that I don't know, you know what I do. I promise to do some homework and then come back to you with a real answer. Nothing cuffed on this show. Now that back-to-school season is right around the corner, it's time to catch up on our summer reading. Back on August 12th, long time ago now, Gary in Texas wanted to know about Harrow Inc. It's another Nashville-based healthcare company that, like HCA, except Harrow's in the pharmaceutical business, specifically eye care. Originally known as Imprimis Pharmaceuticals, this company got its start working with compounding pharmacy suppliers to identify unmet needs. This is all as generic as it gets. They had some success with an eye care product, then decided to focus on actually developing drugs for the industry. These days, Harrow has a comprehensive portfolio of products used in eye surgery procedures, like cataract removal, along with exposure to dry eye disease, glaucoma, allergies, and infections. In particular, they're focused on eye surgery and dry eye disease. This is actually pretty interesting because the eye is such a complicated organ. Eye surgeons might need all sorts of drugs for a procedure, whether we're talking about dilating your pupils or anesthesia or preventing inflammation. As for dry eye disease, this is something that affects an amazing 39 million people in the United States, and roughly half of those cases are of the moderate to severe variety. Harrow still owns its original business, compounding pharmacy space, and they've also got some investments in smaller drug companies focused on eye care. Now, this stock has had a spectacular run, up roughly 258% year to date. That's amazing. Now, many of that's because Harrow reported a stunning quarter earlier this month, which caused the stock to jump more than 50% in a single day. And you know what? It hasn't looked back since. What was so special about that quarter? All right, just listen to what CEO Mark Baum said in the press release under the quote. The second quarter of 2024 marked a financial and operational turning point for Harrow, with revenue surging 46% compared to the same quarter last year and 42% over the previous quarter, end quote. What's driving these impressive growth numbers? First, in May of last year, Harrow launched an anesthetic, something doctors use to numb the surface of the eye before surgery. Apparently, they can't get enough of it because orders for the anesthetic were up 98% just versus the previous quarter. Management also sees room for accelerated growth here after signing 10 additional supply agreements with strategic retina practice accounts in the quarter. They've signed 7 more supply deals just since the end of June, including a recent agreement with the largest and highest volume retina practice group in the country. Second, Harrow's got a drug called TriEssence, which is both an inflammation treatment and also helps doctors see what's going on in your eye during certain key procedures. This thing's got a long history as the drug's been on the FDA's shortage list for the last 5 years, with no inventories available in America for the last 2 years. Last year, Harrow bought the rights to it from Novartis, and they've been working to relaunch it. While they still got to pass a few more tests, management expects a successful relaunch later this year. That could be gigantic. Maybe that's a big reason why it's up. Now, on the dry eye side of the portfolio, Harrow launched some eye drops at the beginning of the year, and they're selling like crazy. According to one of the pharmacy partners, total prescriptions in the second quarter were up an astounding 212% for the first quarter. Matt was adamant that users love these drops and they should keep growing rapidly. I don't know. Sure sounds like it. Put it all together, and Harrow's projecting its revenue in the second half will be dramatically higher than the first half, especially if they can successfully relaunch TriEssence. Previously, CEO Mark Baum had been projecting greater than $180 million in sales for 2024. Now he says it's really a question of how much greater than $180 million that they'll do. I like this. After reaching what Harrow sees as a, quote, turning point, both financially and operationally, management believes they have the potential to reach annual revenues of $500 million by 2027. And after that latest quarter, I can't say this enthusiasm is unwarranted. So that's what sent Harrow's stock in the stratosphere. But is it still worth buying at these levels? Look, I'm always going to be wary of anything. Any stock that's up 250% in less than a year, that's parabolic. You know, I don't like that. While Harrow's sales speak for themselves, the company's still technically not profitable, even though the analysts that follow it believe Harrow will turn a profit next year. Plus, it's already EBITDA positive, which means we can make meaningful value comparisons with the other publicly traded eye care companies here. I'm thinking Bausch & Lomb, Alcon. Now, with management's focus on that goal of $500 million in revenue by 2027, I'm going to do something I shouldn't typically, well, no, I shouldn't say I shouldn't, but I typically do not do on the show. I'm actually going to use 2027 projections to try to value the stock. I don't like to use them because it's so far in advance, but we're going to try it here. According to the current analysis consensus, Harrow can generate $279 million in earnings for interest, taxes, depreciation, and amortization in 2027. Given that the company's current enterprise value stands at just over $1.5 billion, that means it's got an enterprise multiple of just 5.5 using the 2027 estimates. Remember, we're trying to come up with an apples to oranges comparison here. And that's the enterprise value, which is the sum of the company's market cap and net debt divided by the EBITDA. Now, it turns out on the 2027 numbers, Alcon has an enterprise multiple of 14, this is competitors, and Bausch & Lomb stands at 9. So your bull case for Harrow is that their 2027 projections are correct. And as those estimates become more convincing over the next couple of years, the stock's multiple should rise to get more in line where it is with the peers. I could argue, I could even see that. I could see this. Some investors could argue because Harrow's growth rate is expected to be so much higher than Alcon's or Bausch and Lomb's, it actually deserves to trade at a premium to those companies. Now, I wouldn't go that far, but because people are willing to pay up for more established companies. Plus, I'm still not sure how much we should trust that $500 million revenue target for 2027. If everything goes right, Harrow will be a big winner, but who knows if they can deliver. In the end, I'm not quite ready to give this stock a full-throated endorsement, especially considering its recent run and how little I knew about it when the caller first told me about it. While we know why people are excited for this one, and we know what Harrow needs to do to send its stock higher, I just don't know enough about the eye care space to endorse management's targets as gospel. I do know this is a fairly competitive space, and I can't tell if Harrow's products are differentiated enough to stave off the competition. That's why I'd love to have them on the show. Learn more. Open invitation. Bottom line, I'm always on the lookout for these sorts of undercovered stories, so I have to thank Gary, one of our smart viewers, of course, for putting Harrow on our radar. I keep following the company, all right? I promise. I'll go and look at the progress going forward. But for now, I'm just not ready to chase the stock based on some long-term assumptions that are more guess than estimate at this point. That said, I'd love for management to come on the show and prove me wrong. Bill in Massachusetts. Bill.
Hi, Jim. Thanks for taking my call.
Of course, Bill. How are you today?
Fantastic.
Good.
Jim, I just wanted to say one thing. You are an incredible teacher. I've learned so much through you and the club. And Jeff and Regina. All you guys are just incredible.
Oh, thank you. I mean, we all worked hard, and the real pay that we get is that call, is what you just said. That's the pay that we get, okay? Because that's how I feel that this is worth doing, what you just said, Bill, and I really thank you.
Jim, I'm in my mid-60s, and so this money means so much to me. You just don't know. You have no idea.
Well,
I just wanted to be
that's great
here. When our club stocks came in, I went crazy. I bought Nvidia, Meta, Eli Lilly, Vertiv Holdings, Disney, and Nextracker. And what I tried to figure out is how you buy stocks as they come in. I always bought stocks as they went up, and that was a big mistake.
Well, we do have philosophy, and look. I know that we've got a lot of questions to bring in, but you are talking about the fundament, and that's why I want to stop here and just say, thank you for this. I want people to understand we're trying to teach people how to check emotions, how to be clinical, how to understand why a stock could go higher. I was not taught this. I had to teach it myself, and now I'm determined to teach it to others, and I will teach it wherever I have to go. So thank you, Bill, and thank you from my team, our team, because that's what this is about. Let's go to work.
Yes, sir. I would like to, I know before you were positive on Chubb, and I'm interested in picking up some. What do you think?
Okay, so this is, I like to play with an open hand. I have been very torn because I felt if rates were cut, maybe Chubb couldn't make as much money, but they are by far the best, and I would not recommend any other insurer on the show other than Chubb. And thank you for the kind comments. It's been a very tough day, and you just made my day better. Fair enough. Thanks again to Gary in Texas for highlighting Harrow for us. I'm not ready to chase the stock, yet it's definitely one worth watching. I got much more Mad Money ahead, including my post-earnings exclusive with Snowflake. Then has Toll Brothers built a winning formula? I'm giving you my take on whether it's sitting on a strong foundation or a gold mine. Plus, all your calls rapid fire in tonight's edition of the Lightning Round, so stay with Cramer. About 6 months ago, the enterprise software stocks went way out of style at the Wall Street Fashion Show. Among the hardest hit is Snowflake, which helps companies store, organize, analyze, and use their data. Now, here's a stock that was down roughly 43% from its highs in February as of today's close. And it's tumbling again after hours trading, after, frankly, another quarter that simply couldn't excite potential buyers. Now, we know this whole group has struggled this year. At the same time, the data management space where Snowflake competes has become a lot more competitive. I acknowledge the problems this company faces, but now that the stock's been nearly cut in half from its highs in February, hasn't it finally been punished enough? Let's go straight to the source with Sridhar Ramaswamy. He's the CEO of Snowflake. Get a better read on the quarter and his plans for the future. Mr. Ramaswamy, welcome back to Mad Money.
Excited to be here, Jim.
Thank you, Sridhar. Now, I've got to tell you, we're going to get to what's happening in the stock in after hours, but I think it's very important to point out that you actually had a very solid quarter, a lot of better than expected congratulations of the analysts, and big non-GAAP operating margin beat, 2-cent non-GAAP earnings per share beat. So, I mean, I wanted you to give some people a little context of the things you're doing right before we go into what's controversial.
Right. We had a solid quarter, Jim. Our product revenue grew 30% year on year. Remaining performance obligations, which is a measure of how much customers are investing in their future, Snowflake consumption, went up to $5.2 billion, 48% year on year. We released more products in the first half of this year than we did all of last year, and our AI products have been used by more than 2,500 customers. So strong momentum across the board. We also raised our guidance for the year substantially. I feel good about what we got done and what's coming up.
Well, do you think it's possible that people are focused on what we consider to be some margin erosion? I mean, you had 10% non-GAAP operating margin in the third quarter last year, and now it's come down pretty substantially from them. And maybe people are saying, wait a second, if the margins are coming down, there must be too much competition in the space.
I don't think it's that, Jim. We are investing in our future, whether it is in engineering or in sales to go sell the product more. Obviously in investments in things like GPUs, but all of these are going to create a better future for us in terms of driving more top-line growth. And that's the thing to focus on. I focus on delivering amazing amounts of revenue. And we're obviously thoughtful in how we go about doing this. So I would say that's not a long-term worry. But the first thing that I want to get done is substantial product adoption and growth. And
you think that this consumption model works in this environment, but maybe better than ever, given the fact that a lot of enterprise software companies are seeing a lot of competition?
The consumption model works really well because it is value aligned. We work very hard with our customers to make sure that they only bring on use cases that have clear business value. We do that even with AI. We don't ask for blanket investments. And by having this mindset of always focusing on customer value, consumption almost becomes a trailing indicator of what is going on. And this is why we feel confident about the coming quarters. And that's why we raised our guidance for the year, because we feel our model is very aligned with what creates value for our customers.
Okay, well, again, I'm just trying to fill in the puzzle. And I might say that there were probably some people who felt that the May cyber attack that occurred, the security breach may have hurt your company. But on the conference call, it's pretty clear that it seems like it wasn't your fault.
That's right. It was absolutely not our fault. The only customers that had their accounts breached were customers that had user IDs and passwords without things like multi-factor authentication that then had these stolen and then used for unauthorized access. The thing that we tell our customers constantly is make sure that they have multi-factor authentication turned on and having things like network policies, which restrict who can come into the Snowflake security perimeter, also turned on. By the way, we have supported these features for close to 10 years, since 2016. And I'll also tell you, these headlines, and that's what they are, have not really affected our core business with existing or new customers. We obviously talk about security a lot more with customers because we want them to be safe. But the core Snowflake platform is incredibly strong and secure.
I have a question that is difficult for you to ask because you're not at the company I'm going to mention, but there is a sense from some press covers that Databricks is a very formidable competitor to yours. Now, you can't say, well, Jim, you should go ask Databricks. I understand that. But fact is that the press is focused on this kind of dogfight. Maybe that is what's dogging your stock.
I honestly think that competition is a good thing. It's a good thing for our customers. It gives us motivation to go create better products. We have an amazing notebook that is going to be, generally available to all of our customers shortly. And competition makes us all move faster. It is a good thing. But the strength of Snowflake is in the core product, is in our product philosophy of making technology simple, not more complex. We are very, very confident that this is the formula for long-term success. Not a lot of quickly developed things that barely work with each other. And we will focus on our core strength and working with our customers to continue to deliver value.
Understand. Now, you also did, you have a couple of new products that I think maybe one or two, a Cortex or a Snowpark. You should just talk about because the analysts seem to think they're very excited about the new products.
I am very excited about Cortex Analyst. It is, it's a dream of everybody that's been working on analytics for a very long time. It gives business users access to data without needing to know things like SQL, without relying on analysts and various kinds of dashboards to get at data. But we do it the Snowflake way. We make it easy to use, and we also make it reliable, meaning that a business user can actually rely on this to make decisions. If you build something off the shelf, you get like 50% reliability, meaning it's wrong half the time. And so that's our secret sauce, and companies like Bayer are using this to answer business questions with lots more along the way. Those are the kinds of products that very much epitomize what Snowflake is about. It's easy, it's efficient, and it's trustable.
Well, look, I'm going to leave it at that, but I've got to tell you, it is a mystery. We went over all the tough questions, and I thought you answered them very well. I think that you get sometimes a momentum that needs to be broken by the fact that you're doing so well in business, but then again, maybe people just think the stock's too expensive. I don't know, but I'm glad you came on the show, and you gave us a very good acquittal of what's going on. I want to thank Sridhar Ramaswamy. He's the CEO of Snowflake. Read the conference call. You'll think that everybody loved it. I'm trying to figure it out myself. Thank you, Sridhar. Good to see you.
Thank you, Jim. Good to see you.
Mad Money's back after the break. It is time. It's time for the lightning round. Crazy round. For a little forever close to saying that stock tell buy sells for just clear. No, of course, that's got a billion planets down. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Crazy. Let's start with Gary. South Carolina. Gary.
Hey, Jim. Love your show. All the hard work you do for all the investors out there. My question's about New York Mortgage.
Okay, this is one of those companies where you don't know what kind of paper they really own and has a high yield. I have been betrayed by many of these companies over time. They have not worked for me, so I always tell people don't buy. Let's go to Johnny in Georgia, please. Johnny.
Hello, Mr. Cramer. How you doing?
Hey, I'm doing well, Johnny. How about you?
I'm doing fine. Thank you for taking my call. First off, I'd like to thank you and your staff for the job y'all do, giving us the knowledge to make some informed decisions.
That's what we want.
Great, man. You're my horse if you don't ever win a race.
Thank you, man. Thank you
very
much.
I've been a big holder for Zim Integrated for a while, and I was wondering, should I stay on board?
No, I got to tell you, I think it's Zim's time still. I've been saying it's Zim's time, actually, for a while. Ben Stodel and I often look at each other and we think this is Zim's time. I say you hold on to Zim because it's Zim's time. Let's go to Jake in New York. Jake.
Booyah, Cramer. What do Minicucci, Culp, and Fairbank have in common? They leave their decisions with the professionals. I know, right? I think I can say Mullis sucks without stepping on toes. So with DJT incoming and maybe Khan outgoing, should I hit up PJT?
Jeez, I'll tell you, it is such an it's a dice roll. I can't find out a lot about it. I have to be more certain about a company before I can opine it for it on this show. And now I'm going to go to Paul in New Jersey. Paul.
Yes, Jim. It's a great day to be alive. NNE, nano-nuclear energy. Will that fill requirements for the energy need for AI?
You know, the problem is that this has got a company that doesn't make money. And I'm reluctant to do that. I know that we all want to play nuclear energy as a way to be able to get cheaper power for the data centers. I'm not going to recommend nano as the way to do it. Let's go to Brandon in Illinois, please. Brandon.
Hey, Jim. Thanks for having me.
What's up?
I want to talk to you and ask you a question about a fiber and telecommunications holding company. It's up 6% for the week and 323% for the month. That company is Lumen Technology.
Yeah, this is a parabolic move. It would have been great to be able to be in something that was network security and cloud solutions. It was easy to see for some. I was blind to it, and the trade is done. Scott in Indiana. Scott.
Booyah, Jim.
Booyah.
So, a new club member here, first-time caller, and but a long-time listener.
Thank you very much.
I know Yes, sir. I know you have it in your charitable trust, but how are you feeling about IBM? Still a buy?
I think IBM's doing a great job. I think that Arvind Krishna is just remarkable. He's done so much good with IBM. I would hold on to it or buy some. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, take it to the house, the home builder in a neighborhood of their own. More next.
Looks like Toll Brothers put on another clinic this quarter. The earnings, the sales, the margins, the orders, they're all fabulous. But if you want to know what was really outstanding, it's the discipline this high-end home builder is showing. A few years ago, CEO Doug Yearley made up his mind that one of the best uses of his capital was to buy back stock. Why? Because the marketplace constantly undervalued Toll's land, its business model, and the demand for expensive homes. So we figured, what the heck? If the stock's going to stay undervalued, company should buy back every share it could get. And I think that, more than the extraordinary good sales, is what allowed this home builder stock to rally like a tech stock on steroids, including today, almost 6% gain. The quarter Toll Brothers reported last night had the same message. As Yearley said on the conference call, quote, since the start of our third quarter, we've repurchased $246 million of our common stock, bringing our year-to-date repurchases to $427 million at an average price of approximately $119 per share. The stock just closed today at $141. Nice buy. To date, Yearley's explained that Toll Brothers has repurchased roughly 3% of their share count, and since 2016, do you know that they've bought back roughly half of the company? Not only that, Toll isn't satisfied with the scale of the repurchases still. They actually raised the buyback for the full year from $500 million to $600 million. These guys don't fool around. Maybe that doesn't sound very impressive to you, but it's truly amazing if you know the history of the home builders. See, in the old days, the home builders seemed addicted to building homes. Management couldn't stop. They always seemed anxious to build as many homes as possible to sate demand. You might think that's the core business, so of course they should build lots of homes. But no, actually the business is making money. And often that means maybe building fewer homes and buying back more stock. Toll Brothers now understands that. They'd rather double down on their own land by buying back stock on Wall Street than building homes on it from Main Street. And they've been dead right. The stock is a horse, in large part because there's just not a lot of homes for sale, and there's not a lot of shares for sale either. Now, Yearley's not immune to the seminal housing issue of our time, the problem of golden handcuffs, where people who got extremely low-rate mortgages thanks to the Fed's easy money COVID policies simply refuse to sell because they'd have to then buy a house with a new, much more expensive mortgage. Given that housing prices are up huge since 2019, financing is a real issue. Unless that is you're very, 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 very rich. You don't need to borrow money to buy a home. Fortunately for Toll Brothers, they cater to the very rich. How else can 28% of their customers pay with cash? While 72% of those who took a mortgage still put down an average of 31% as a down payment. Remember when they used to put no money down? Toll has wealthy buyers everywhere. It's a testament to their domination of the high end that they can say that they have strong markets in New Jersey, Pennsylvania, Metro D.C., South Carolina, Atlanta, Boise, Las Vegas, and all of California. Here again is where we see the versatility of buying back stock versus selling homes. Because Toll wants 50% of its homes to be spec, meaning a home without a buyer that has a foundation for it. The Federal Reserve wishes the home builders would flood the zone with specs, which would bring the price of housing down. But why would the home builders want cheaper housing? They'd rather build fewer homes, really good homes, and then sell them at a full price. In the end, Toll Brothers is the embodiment of the modern-day successful home builder, no matter what the milieu. Build high-quality products to please the buyers, buy low-price stock to please the shareholders. It is a very winning formula. I just wish more of their competitors adopted it. I'd like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.